is the monetary policy statement for the month of June. As you are aware, this monetary policy statement over a time frame of over a duration of about 25 to 30 minutes over the last 3 to 4 years, especially since the onset of the pandemic, has become an important instrument which has enabled the Reserve Bank to communicate the gist of the monetary policy decisions and the rationale behind it. And what is more, this has also given us an opportunity to explain Reserve Bank's assessment of the overall economic situation, both global and domestic, and also our assessment of the prevailing financial market conditions. So in that way, I think this has enhanced the entire process of communication from the Reserve Bank to a wider cross-section of people and stakeholders. So in that sense, we have great amount of satisfaction from doing that. And from time to time, we have been getting suggestions from many of you, and we try and incorporate your suggestions also into our statements and into our communication. Thank you very much for that. And the statement is as follows. As I make this monetary policy statement, we can derive satisfaction from the fact that the Indian economy and the financial sector stand out as strong and resilient in a world of unprecedented headwinds and swift cross-currents. Unlike the previous 3 tumultuous years, the uncertainty on the horizon appears comparatively less and the path ahead somewhat clearer. But we have to be acutely aware that the geopolitical conflict continues unabated and policy normalization globally is far from complete. Headline inflation across countries is on a downward trajectory but is still high and above the targets. Labor markets in many countries are tight and demand is rotating back from goods to services. Hence, central banks across the world remain on high alert and watchful of the evolving conditions, even though many of them have tempered their rate hikes or even taken a pause. Financial stability concerns persist in advanced economies, although they appear to have been contained due to resolute actions. Retrenchment in trade, technology, capital flows caused by geopolitical fault lines and economic fragmentation further complicate the situation. In these challenging times, the Reserve Bank of India has continued to focus on preserving price and financial stability, while ensuring adequate flow of financial resources to all productive sectors of the economy. As a result, domestic macroeconomic fundamentals are strengthening. Economic activity is exhibiting resilience, inflation has moderated, the current account deficit has narrowed, and foreign exchange reserves are comfortable. Fiscal consolidation is also ongoing. The Indian banking system remains stable and resilient. Credit growth is robust and domestic financial markets have evolved in an orderly manner. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. As many of you would be aware, the Monetary Policy Committee met on 6th, 7th and 8th June, and based on an assessment of the macroeconomic situation and outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility and the bank rates, they stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on both policy rate as well as the stance. The MPC recognized that the pace of global economic activity is expected to decelerate in 2023. That's in the current year. And this is mainly because it is getting dragged down by elevated inflation, tight financial conditions, and geopolitical tensions, which are still continuing. The pace of monetary tightening has slowed in recent months, but uncertainty remains on its future trajectory as inflation continues to rule above targets across the world. And in the last few days, you would have noticed that two major central banks have, after adopting a pause for several months, they have gone for increasing the policy rates. So therefore, what I am saying is that the monetary policy, the pace of monetary policy has slowed, tightening of monetary policy has slowed down, but uncertainty remains on the future trajectory as inflation continues to roll above targets across the world. In India, consumer price inflation eased during March-April 2023 and moved into tolerance band, declining from 6.7% last year, that is 22-23. Headline inflation, however, is still above the target as per the latest data and is expected to remain so according to our projections for 23-24. So when I say headline inflation is still above the target, I am referring to headline inflation as per our assessment will remain above 4% throughout 23-24. Therefore, close and continued vigil on the evolving inflation outlook is absolutely necessary, especially as the monsoon outlook and the impact of El Nino remain uncertain. Real GDP growth in 2022-23, on the other hand, turned out to be stronger than anticipated and is holding up well. The policy repo rate has been increased by 250 basis points since May last year and is still working its way through the system. Its fuller effects will be seen in the coming months. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will continue to remain vigilant on the evolving situation and the growth outlook. It will take further monetary policy actions promptly and appropriately as required to keep inflation expectations firmly anchored and bring down inflation to the target. With the policy repo rate at 6.5% and full year projected inflation for 23-24 at just a little above 5%, the real policy rate continues to be positive. The average system liquidity, however, is still in surplus mode and could increase as rupees 2,000 banknotes get deposited in the banks. Headline inflation, as noted before, is easing but rules above the target, warranting close monitoring of the evolving price dynamics. Taking all these factors into account, the Monetary Policy Committee decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now proceed to provide our assessment of growth and inflation. Let me first focus on growth. India's real gross domestic product, that is real GDP, recorded a growth of 7.2% in 2022-23, stronger than the earlier estimate of 7%. It has surpassed its pre-pandemic level by 10.1%. Real GDP growth in the fourth quarter of 22-23 accelerated to 6.1% year-on-year from 4.5% in the third quarter of last year, aided by fixed investment and higher net exports. On the supply side, real gross value added, that is GVA, accelerated from 4.7% in Q3 to 6.5% in Q4, driven by rebound in manufacturing activity, which moved into expansion territory after 2 quarters of contraction. Turning to 23-24, domestic demand conditions remain supportive of growth on the back of improving household consumption and investment activity. Urban demand remains resilient with indicators such as passenger vehicle sales, domestic air passenger traffic, and credit cards outstanding posting double-digit expansion on year-on-year basis in the month of April. Rural demand is also on a revival path. Motorcycle and three-wheeler sales increased at a robust pace year-on-year in April, while tractor sales remained subdued. Growth in steel consumption and cement output and production and imports of capital goods suggest continued buoyancy in investment activity. On the back of double-digit growth of 15.6% in non-food bank credit, the flow of resources to commercial sector in the current year, that is 2023-24, up to May 19th, increased to 2.7 lakh crore from 1 lakh crore during the same period last year. Fixed investment by manufacturing companies expanded in 22-23, reversing the contraction seen in 21-22. Our surveys also point towards higher investment intentions of manufacturing companies for 23-24, that is for the current year. The contraction in merchandise imports outpaced that of merchandise exports in April, resulting in a narrowing of trade deficit. Coupled with sustained and strong growth in services exports, the drag from net exports on growth is easing. On the supply side, the 8 core industries output expanded by 3.5% year-on-year in April, compared with 3.6% in the month of March. The Purchasing Managers Index, that is PMI for manufacturing, exhibited sustained expansion, rising to 58.7 in the month of May, which is a 31-month high. Available high-frequency indicators suggest that services sector activity has remained on an accelerating trajectory. PMI services remained in strong expansion at 61.2 on top of 62 in April. Looking ahead, higher Rabi crop production, expected normal monsoon, continued buoyancy in services, and softening inflation should support household consumption. On the other hand, given the healthy twin balance sheets of banks and corporates, supply chain normalization, and declining uncertainty, conditions are now favorable for the capex cycle to gain momentum. Robust government capital expenditure is also expected to nurture investment and manufacturing activity. Consumer and business outlook surveys display continued optimism. The headwinds from weak external demand, volatility in global financial markets, protracted geopolitical tensions, and intensity of El Nino impact, however, pose downside risks to the outlook so far as growth is concerned. Taking all these factors into consideration, the real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%, with risks evenly balanced. Let me just give the figures once again. So the GDP growth, real GDP growth projection for the current year 23-24, the projection that we are making is 6.5%, and the quarterly breakup is as follows. The first quarter, the estimate is that it would be 8%, second quarter 6.5%, third quarter 6%, and fourth quarter 5.7%, and the risks are evenly balanced. Let me now turn to inflation. Headline CPI inflation has come down during March-April 2023 to 4.7% in April, the lowest reading since November 2021. Monetary policy tightening and supply-side measures contributed to this process. The easing of inflation was observed across food, fuel, and core, that is the CPI excluding food and fuel categories. That means all categories of headline inflation witnessed, easing of the inflation pressures. Food inflation declined to 4.2% in April, while core inflation moderated to 5.1%. A durable disinflation in core component would be critical for a sustained alignment of the headline inflation with the target. Going forward, with the recent Rabi harvest remaining largely immune to adverse weather events, the near-term inflation outlook looks more favorable than at the time of the last MPC meeting in April. The forecast of a normal southwest monsoon by the Indian Meteorological Department, IMD, augurs well for the Kharif crops. Uncertainties, however, remain on the spatial and temporal distribution of monsoon and the interplay between El Nino and the Indian Ocean dipole. Geopolitical tensions, uncertainties around the monsoon and international commodity prices, especially sugar and rice and also crude oil, and the volatility in global financial markets pose upside risks to inflation. Taking into account these factors and assuming a normal monsoon, CPI headline inflation is projected at 5.1% for 23-24, with Q1 at 4.6%, Q2 at 5.2%, Q3 at 5.4%, and Q4 at 5.2%. The risks are evenly balanced. As noted in the April statement, the decision to pause was based on the need to assess the cumulative impact of past monetary policy actions while charting out our future course. Subsequent incoming data suggest that while risks to near-term inflation have moderated somewhat, pressures remain during the second half of the year, which needs to be watched and addressed at the appropriate time. According to our survey, inflation expectations of households for 3 months to 1 year ahead horizon have moderated by basis points since September 2022. This would indicate that anchoring of expectations is underway and that our monetary policy actions are yielding the desired results. This also provides us the space to keep the policy rate unchanged in this meeting of the MPC. At the same time, given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4% going forward. As Mahatma Gandhi had said, the ideal must not be lowered. The continuation of stance of withdrawal of accommodation should be seen from this perspective. I would now like to turn to liquidity and financial market conditions. Surplus liquidity has, as reflected in average daily absorptions under the LAF at rupees 1.7 lakh crore during April-May, was lower than 2.9 lakh crore rupees during the full year 22-23. The shrinkage in surplus liquidity during April-May was, among other things, due to maturing of the TLTROs which we had extended, which we had given during COVID times. The seasonal expansion in currency in circulation and build-up of government cash balances during this period also moderated surplus liquidity. Since the third week of May, however, the decline in currency in circulation and pickup in government spending have expanded system liquidity. This has got further augmented due to the Reserve Bank's market operations and the deposit of rupees 2,000 bank notes in the banks. The prevalence of surplus liquidity amidst higher recourse to marginal standing facility MSF by some banks suggests skewed liquidity distribution within the banking system. To address this situation, the Reserve Bank conducted a 14-day variable rate auction, that is a VRR auction, amounting to rupees 50,000 crore as part of its main operation on May 19, 2023. Similar to two such auctions conducted earlier in February and March this year. Reflecting swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction. The earlier one I referred to was variable rate repo auction. Now I am referring to variable rate reverse repo auction, which is VRRR. So, reflecting the swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction, that is a VRRR auction of 2 lakh crore on June 2nd. And thereafter, we have gone on to conduct a 4-day VRRR auction of 1 lakh crore on June 5th, a 3-day VRRR auction of 75,000 crore yesterday, day before, that is on June 6th, and a 2-day VRRR auction, let me say, a VRRR auction of 75,000 crore on June 7th. Now, this was done considering the overall build-up of surplus liquidity. The response to these auctions, these VRRR auctions, has been cautious in, as per our experience, that is these VRRR auctions which we conducted over a period of last 4 or 5 days. The response from the banks has been fairly cautious. Going forward, the Reserve Bank will remain nimble in its liquidity management while ensuring that adequate resources are available for the productive requirements of the economy. The Reserve Bank will also ensure the orderly completion of the government market borrowing program in the current year. The moderation in system liquidity, along with its skewed distribution, was reflected in firming up of money market rates even beyond the repo rate on a few occasions before they came down from May 18 to sub-repo rate levels. Long-term rates have, however, remained broadly stable. This has led to sharp compression of term spreads in the recent period. The relative stability of long-term yields augurs well for the economy and suggests effective anchoring of market-based long-term inflation expectations. I would now like to briefly talk about the external sector. In recent months, the trade deficit has narrowed on the back of sharper decline in imports vis-à-vis exports. India is making resolute strides to achieve the $1 trillion merchandise export target by 2030 by focusing on diversification of markets and products, leveraging free trade agreements, strengthening manufacturing capacity and competitiveness by participating in value chains, and through schemes such as the production-linked incentive across sectors. Service exports and remittances have provided valuable support to India's external sector viability. During 22-23, services exports grew faster at 27.9% than merchandise exports, which grew by 6.9%. The current account deficit, that is expected to have moderated further in Q4 22-23 and should remain eminently manageable even in 23-24, that even in the current year also. On the financing side, foreign portfolio investment, that is FPI flows, have seen significant turnaround this year since April, that is in 23-24, led by equity flows. The net FPI inflows stand at US dollar 8.4 billion during the current financial year up to 6th of June, as against net outflows in the preceding 2 years, and the net outflows in the preceding 2 years were US dollar 14.1 billion in 21-22 and 5.9 billion last year in 22-23. Net FDI flows to India were $28 billion in 22-23 compared to $38.6 billion in the previous year. Preliminary data for April 23 suggest that FDI flows have also improved. Net inflows under non-resident deposits, net resident inflows under non-resident deposits increased to $8 billion during 22-23 from $3.2 billion in the previous year. The Indian rupee has remained stable since January this year. Overall, India's external sector remains resilient as key indicators such as current account deficit to GDP, external debt to GDP, and international investment position, IIP to GDP, all these ratios continue to improve. Foreign exchange reserves stood at a comfortable level of US dollar 595.1 billion US dollars as on 2nd June this year. Inclusive of net forward assets, our foreign exchange reserves are well above 600 billion US dollars. I shall now announce certain additional measures. There are about 8 additional measures, and I think all of them are quite important, so I request your patience for some more time. The first announcement relates to borrowing in call and notice money markets by scheduled commercial banks. The extant regulatory guidelines prescribe prudential limits for outstanding borrowing in call and notice money markets for scheduled commercial banks. With a view to providing greater flexibility for managing their liquidity, it has been decided that scheduled commercial banks, excluding small finance banks, can set their own limits for borrowing in call and notice money markets within the prescribed prudential limits for interbank liabilities. Second announcement relates to widening the scope of framework for resolution of stressed assets. Compromise settlements is recognized as a resolution mechanism in respect of non-performing assets, that is NPAs, under the prudential framework of the Reserve Bank, which is currently applicable to scheduled commercial banks and select NBFCs. It is proposed to issue comprehensive guidelines on comprehensive settlements and on technical write-offs, which will now be made applicable to all regulated entities, including the cooperative banks. Further, it is also proposed to rationalize the existing prudential norms on restructuring of borrower accounts affected by natural calamities. The next announcement relates to a default loss guarantee arrangement in digital banking, popularly what is known as the FLDG in digital banking. The Reserve Bank had issued the regulatory framework for digital lending in August-September last year. With a view to further promoting responsible innovation and prudent risk management, it has been decided to issue guidelines on default loss guarantee arrangements in digital lending. This will further facilitate orderly development of digital lending ecosystem and enhance credit penetration in the economy. The next announcement relates to priority sector lending targets for primary urban cooperative banks. The Reserve Bank has undertaken several initiatives in recent years to strengthen the urban cooperative bank sector, that is the UCB sector, as well as to deepen financial inclusion. Such initiatives include revision of the priority sector lending targets for UCBs in 2020. While revising the priority sector lending targets, a glide path up to March 2024 was provided for a non-disruptive transition to achieve the revised targets. While a number of UCBs, that is urban cooperative banks, have met the required milestones as on March 2023, a need has arisen to ease the implementation challenges faced by the other UCBs. It has therefore been decided to extend the time frame for achieving the targets by 2 more years, that is up to March 2026. Further, urban cooperative banks, UCBs, which have met the targets as on 31st March 2023 shall be suitably incentivized. The next announcement relates to rationalization of the licensing framework for authorized persons under Foreign Exchange Management Act, that is FEMA. The licensing framework for authorized persons issued under FEMA was last reviewed in March 2006. Keeping in view the developments, including progressive liberalization under FEMA over the last several years, and to effectively meet the emerging requirements of the rapidly growing Indian economy, it has been decided to rationalize and simplify the licensing framework for these authorized persons. This is expected to improve the efficiency in delivery of foreign exchange facilities to various segments of users, including common persons, tourists, and businesses. The next announcement relates to expanding the scope and reach of e-rupee vouchers. At present, purpose-specific e-rupee digital vouchers are issued by the banks. It is now proposed to expand the scope and reach of e-rupee vouchers by permitting non-bank prepaid payment instruments issuers, that is PPI issuers, to issue e-rupee vouchers. It is also proposed to enable issuance of e-rupee vouchers on behalf of individuals and to simplify the process of issuance, redemption, and a few other aspects of the current framework. These measures will make the benefits of e-rupee digital voucher accessible to a wider set of users and further deepen the penetration of digital payments in the country. Next announcement relates to streamlining the Bharat Bill Payment System processes and membership criteria. The Bharat Bill Payment System, that is BBPS, is operational since August 2017. The scope of BBPS was further expanded in December 2022, that is December last year. To further enhance the efficiency of the BBPS system and to encourage greater participation, it is proposed to streamline the process flow of transactions and membership criteria for operating units. The next announcement, and I think that's the last one, relates to internationalizing issuance and acceptance of the RuPay cards. RuPay debit and credit cards issued by the banks in India are gaining increased acceptance abroad. It has now been decided to permit issuance of RuPay prepaid forex cards by the banks. This will expand the payment options for Indians traveling abroad. Further, RuPay cards will also be enabled for issuance in foreign jurisdictions. These measures will expand the reach and acceptance of RuPay cards globally. Let me now conclude, and there are some important messages in this concluding para, so I request again your patience for just a couple of minutes. We have made good progress in containing inflation, supporting growth, and maintaining financial and external sector stability. Despite 3 years of global turmoil, India's growth has bounced back and headline CPI inflation is easing. This confluence of factors gives us the confidence that our policies are on the right track. Nevertheless, we need to move towards our primary target of 4% inflation. It is always the last leg of the journey which is the toughest. I wish to emphasize that we will do whatever is necessary to ensure that long-term inflation expectations remain firmly anchored. The best contribution of monetary policy to the economy's ability to realize its potential is by ensuring price stability. The Reserve Bank will remain watchful and proactive in dealing with the emerging risks to price and financial stability. Let me end by recalling the inspiring words of Mahatma Gandhi. If we are determined, we shall find the way that leads us to our goal. Thank you. Namaskar.
Well, you will have to admit that an expected dovishness is not there. As expected, a pause. As expected, stance.
Yeah, your volume is low. Let me try increasing it to high level. Yeah. Yes.
rates with a battery of experts. But let me first take you through what has happened and what exactly the governor has said. You know, Stacey, the governor, in governor's words, it's the last leg of the journey which is the most painful, and that is what has been evident in his tone, given the fact that RBI governor has said that though the monetary policy pace has slowed down, but the future path still remains uncertain. So he hasn't really indicated that we are at the end of the rate hike cycle. But the good news is the fact that for when it comes to inflation forecast for the full year, inflation forecast has been scaled down to 5.1% from 5.2%, and for the current Q1. The GDP, in fact, the inflation forecast has been scaled down, and even for the second quarter, it has been scaled down. Even though quarter 3 and quarter 4 have been retained, given the fact that we don't know how the El Nino situation will pan out, and which is why the markets have reacted in a positive way, because as expected, RBI has held policy rates at 6.5%. No change in stance. Of course, 5 of the members voted in favor of withdrawal of accommodation, but there was one vote against this stance. So maybe there is some bit of little bit of shift towards neutral, at least from one member. But that shift was something that the markets weren't really expecting. But in that sense, if you look at the GDP growth forecast, it has been retained at 6.5%, given the fact that the FY23 GDP growth of 7.2% was fairly strong, and the governor has made a note of that as well. So no dovishness coming out of the governor's tone.
And I think that's exactly what the markets were expecting and had factored in already, because they weren't looking at the stance. They were hoping there would be, but status quo is what it is.
Status
at the
quo
end of the day
was already priced in, and I think it's a cut in inflation forecast for
that is what will perhaps
be
cheered by the markets.
We saw some bit of uptick coming in on the markets. But let's go across to our guests.
Let's go to our guests. I have Aditi Nair, the chief economist and head of research at ICRA, joining in. We also have Kunj Bansal of the National Institute of Security Markets, who are joining in. Thanks to both of you all for giving us your time. Let's get a sense of how are you reading these this policy, a second one in a row with maintaining that status quo. Aditi, this is on expected lines, but how much does it change from here on? What can we really expect?
Thank you. Well, absolutely on expected lines. We were expecting there to be a pause today, and the pause is also unanimous. So that was interesting to see that actually, as far as the rates itself, there is no shift in the voting pattern that we found this time. All the members wanted to go ahead with the pause. And even with the stance, we only had one dissenting vote. So overall, the tone of the governor and the way that he emphasized that inflation needs to come close to the target of 4%, we think that actually there was a lot of hawkishness that underlined the messaging that he was giving. And we think that the pivot to rate cuts is certainly quite far away.
Right. Let me go to Kunj. Kunj, on expected lines, policy rates have been held, stance also, retained. But, it's a cut in inflation. Even though the RBI governor has said that we need to get closer to the 4% target, we are quite far ahead of that. But do you think it's the cut in inflation forecast for the first 2 quarters that has, given some bit of a, cheer to the markets in today's session?
Not necessarily. I think markets in general had been doing very well earlier itself. There is no positive or negative surprise as far as market is concerned in terms of the statement from RBI, which is a very good thing. You can't expect a central banker or a central bank to keep giving shocks by keep varying its policies in a very short period of time. They need to be cautious. They need to be looking at it from the medium and long term, and that's what they have done. Coming to markets had been doing very well earlier also. The impact of so many things, the quarterly result season which went past was largely in line with expectation. The renewed FII inflow which was missing, in fact, RBI governor also talked about that. In fact, gave the numbers of the April and May that we have received. So that has been the reason. The metal price corrections. In fact, year to date, we have had both ferrous and non-ferrous metals put together around 20% correction in different range. And the oil price remaining range bound. It hasn't corrected much. It hasn't gone up also. So these are the factors. Market had anyway been positive. RBI policy from the market's perspective has largely been in line. market would have been happy to see the upping of GDP expectation growth rate for FY24. But market is market. It would want so many things. As I said earlier, central banker is not supposed to be guided by market, but more guided by their own analysis, which they have done.
Right, Kunj. Coming to you, Aditi, the RBI governor hasn't really indicated that, we are, at the end of the rate hike cycle in so many words. But would it be safe to assume that, given the fact that growth has picked up, inflation is easing, of course, the path remains uncertain in the wake of, how El Nino conditions really shape up going forward. But can we still assume that we have the rate hike cycle has peaked out, and here on, this is a longish pause that we are looking at?
Yeah, that's definitely our baseline expectation, that there is really unlikely to be any more rate hike unless we have a very negative surprise on inflation going ahead. And as the RBI governor pointed out, it's really not just coming into the 2 to 6% band that's enough, but the 4% inflation target is what needs to be achieved. And therefore, we think that the pause is going to be pretty long. For all the quarters that the inflation forecast was shared by the governor, for Q2, Q3 and Q4, we're still above 5%. And this is definitely something that suggests that we are in for a pretty long pause.
That's right. We also have Jaideep Iyer, the head of strategy at RBI Bank, also joining in this conversation. Jaideep, from a banker's perspective, nothing much is changing in terms of those, interest rates. But the governor did point out that liquidity is in the surplus mode, and we're going to have the withdrawal of these 2,000 rupee notes. How is that all going to shape up, and what would the banks really like more from the central bank then? For you.
Yeah, so sorry, was that for me?
Yes, Jaideep, that question was for you. Yes.
Yeah, I'm Anil Rego, so maybe that's where the difference is. Okay, so yes, definitely the RBI policy of pause is something which is keeping in mind inflation sort of coming down. So that's the positive, and from here one believes that it'll probably stay that way for some time, till maybe there's a little bit more comfort from the RBI, because typically there is a lag between the decision, and they don't look at it on a futuristic basis. They want to see data coming in, and then they make some of the moves there. And I think that's been a conservative one. Yes, I think the fear right now is El Nino. So if you go back and see even the GDP growth forecast, sort of being conservative out there. So I think all in all, one thinks that from here RBI will be on a pause mode for some time, and hopefully at some point of time we'll also probably see rate cuts in.
Right. Thanks so much for that, Anil Rego, for giving us that perspective. Anil Rego of Right Horizon there coming in. But let me go back to Aditi. Aditi, all of this, like we've been pointing out, markets would have definitely expected that GDP forecast also to have kind of changed, but inflation projection, that's the one that the governor has decided to go in. But let's look at those other factors that he pointed out. A lot coming in for the digital payments front. There are a couple of announcements on that lines. How was this something? The e-rupee also was something that was taken up. Throw some light on all of these that the RBI is now turning their focus on really.
See, I'll, let me first speak on the liquidity side. Definitely there also the governor spent quite a bit of time talking about liquidity, and also about the 2,000 rupee notes and how that's expected to boost the liquidity surplus going ahead. And overall continued vigilance, that is something that he has been emphasizing. There'll be on both sides. That is again something that we've been hearing the last few policy statements. And lastly, as far as the orderly evolution of the yield curve is concerned, that is another point that he emphasized in this policy as well. And if we look at how the bond yields have moved in the last couple of months, the 10-year GSEC yield has been just around the 7% mark, and that is something that we had really not expected before the surprise pause that came in the previous policy. So it's actually been quite an interesting last couple of months for the bond yields. First, we started off with the surprise pause from the RBI, from the MPC. We've seen some amount of uncertainty as far as global central banks are concerned, with expectations on pauses, extended pauses, hikes intermittently based on data, as well as some calls for cuts. And also, as far as the Indian bond supply is concerned, certainly state government supply lagged expectations, especially in April. And that is also something that possibly helped yields to come down to the 7% mark. How long they'll end up staying there, I'm not certain that they can decisively remain below 7% for an extended period of time. So possibly this is going to be the range that we're going to see for some time, until there is a lot more clarity that there is going to be a rate cut coming very soon. So I would imagine that this is the range that we're going to see for some time.
Right, Aditi, a rate cut coming soon, but how soon? There are two camps in the market really. One group believes that, a rate cut could come as soon as October, December, but there is another, set of views coming in that, we could look at a rate cut somewhere around the first quarter of the second, in fact, 2024. What is your base case scenario here?
See, our base case scenario is that if the focus is so clearly on inflation coming to 4%, and if the MPC expects inflation to remain above 5% in Q2, Q3, and Q4, it's really unlikely that we're going to get a rate cut as early as October or December of 2023. So at best, we're going to get rate cuts coming sometime, I would say, toward the middle of next year. That's my base case right now, because I don't think inflation is going to fall to 4% and stay there in a sustainable manner this quickly. I just don't think that it's going to happen this quickly.
I want to also talk about the global rate hike cycle. Australia, Canada, we saw these two nations, in fact, go ahead and hike rates once again after a pause, and which is what is expected out of the Fed also next week. Market participants are saying that maybe June policy, they'll look at a pause, and July is when they will look at a rate hike. So globally, do you think Fed's 25 basis point rate hike in July could be the last one?
I do think so. I think that, maybe one more hike and a pause after that from the Fed. Their rate cuts may surely come sooner than what we have in India. I mean, we're not discounting that possibility. But for the Indian market, given where we see the inflation trajectory over the next few quarters, we think that our pivot is going to be at least a few quarters away.
Right. Let me go back to Kunj. Kunj, give us a perspective on how markets are going to move on from here. We've seen the Nifty gain almost 6% since the last RBI policy, but how are we going to look at market? What are they supposed to take away from what has happened today, or is this just going to be a wait and watch approach that everyone in the markets too are going to take?
Yeah, so excuse me. Let me put some numbers for our viewers and listeners in addition to what you have said. One, market is up almost 10% from the 1.5 month low of around 16,800, 900 Nifty that it was, or 2 months ago that it was. So that's one way to look at it. The other way to look at it, that the Nifty index was more or less at the current level in October 2021. So it's almost 20 months that the Nifty hasn't given any return, or market hasn't given any return. So that's the second way to look at it. Coming back to today's market, let me take a mix of the RBI policy's impact and the ongoing factors and the expected factors. I think next few months market will be governed more by the monsoon, very important. On one side, there is an El Nino prediction. On the other side, IMD expects normal monsoon. So one will have to wait and watch. India, despite 75 years of independence, continues to remain a monsoon-dependent agrarian economy. So that will be one factor which market would, of course, like to watch out for. RBI policy having come in line with expectation, next week we have the US Fed policy coming in. So market would be keenly watching towards that also. Also in terms of the impact that might have on the global inflows, which have just started to come in. The third point is that with this kind of 10% rise in indices having come, large cap indices close to life highs, the valuations also tend to get matured at some point of time. So that's the other thing market will be looking at. So these are the factors which market will be looking at going forward. Having seen the RBI policy which has come in line with expectation, let's see how the market shapes up. In my view, it will remain range bound for now without taking a significant sharp upward or downward movement.
Right, Kunja. I also want to talk about, how things are shaping up globally. Advanced economies are, in fact, looking at a recession. And in fact, Germany has already slipped into one. But even though India is emerging as a bright spot, do you expect this outperformance to continue? And, because we've all heard the phrase that, when America catches cold, the world sneezes. So how do you expect India to perform going forward if, in fact, America, faces a hard landing going forward?
So a lot of things, one we already have seen that how Indian market earlier that there was a reasonably short period of trend to see the decoupling, but now we have a reasonably long period of about I think close to 2 years of decoupling being there. In fact, the whole Indian market kept outperforming in the calendar year 2022 when US was not doing well. Then leave aside last 2 months, it sharply underperformed to come in line with the global market, to come in line specifically with the US market. And last 2 months, we have again seen it catching up. So that's one. Second thing, we keep talking of global economies being recession. Let me restrict myself to the US. I don't know where is the recession. The US market themselves are at close to 8-9 months high. The Nasdaq, the Dow Jones have started to do very well again. Of course, in case of Nasdaq, it might be specifically to do with the technology companies, given the sudden emergence of the artificial intelligence coming up. Technology as a sector has already been quite in the demand in terms of the go-to area. If you see the productivity enhancement to be done, if you want to bring in manufacturing efficiencies and things like that. So there is a little dichotomy to me in terms of talks of recession, but markets don't seem to be pricing in that. Now, add to that, let's say the next week the US Fed gives a pause. Not that I am an expert, but my expectation is that it will indeed give a pause. So what happens to the US market? Does it continue to go up, or has it already built in? So there are a lot of factors which are in play here. Coming back to Indian market, the expectation from the Indian market in terms of outperformance, yes. So let's say the FY24 GDP growth rate prediction of RBI is at 6.5%. That's one number. World Bank prediction is 6.3%. That's another number, which is lower than the RBI. Let's get more conservative if we want to. Let's say it will be 6%. Now that 6% number will be not amongst, in fact, the highest in reasonably sized, or in fact amongst the biggest economies of the world. Now, if that is the case, where the money will go, global money will sooner or later come back to India, looking at various other factors. If US interest rate hike takes pause anyway, then the money allocation will start shifting more and more from the US debt market or US market itself to the other markets, which part of which will come to India. So I think that outperformance could continue. Now, that outperformance not necessarily be that it will be in the way of Indian indices continuing to go up. It might be in the way of Indian indices continuing to maintain a certain level. Could be the more away the things will be.
Right, two sectors specifically I want to speak about. First is the IT sector. Given the kind of global macro environment, Kunj, we have seen that, of course, it has impacted the fourth quarter numbers for some of these IT majors. In fact, even Q1 is expected to be extremely weak. Given the fact that discretionary spending is slowing down. I know there has been in fact a pullback in client spending as well, as indicated by some global giants. So how do you expect IT stocks to shape up going forward? Do you think there is headroom for valuation, and there are people who believe that this could be a good time to actually look at buying into these stocks, given the fact that after a couple of quarters of slowdown, things may improve in the future. So what is your take?
Okay. So when it comes to IT sector, specifically the Indian IT sector, the domestic IT sector, let me highlight 2-3 key features of this sector. It's a consistent cash generating machine, cash generating companies, almost all the decent large cap and mid cap, even some of the small cap companies also number one. As a result, all of them are net cash companies. Number two. Number three, there is a reasonable certainty of ability to be able to reasonable predictability in the business that can be there. What is the down? Before I go to the downside, let me also add the fact that the cost employee cost, which had started to shoot up sharply till 2 quarters ago, has now started to come down. Now, what is the downside is, yes, the growth rate could be lower than what one wants, what one expects, or what has been historical. But even if that be so, the fact that the cash generation will continue, the profitability will continue, wouldn't go away. So that's those are the inherent benefits of investing in IT sector. Short-term volatilities, trading opportunities will always be there. But for the medium-term investor, I think it's a go-to sector which has to be core part of the portfolio. It can keep giving returns over a period of time. But yes, for the traders also at the same time, there could be opportunity in terms of correction. We could see that in when we have the June quarter numbers also coming in after the guidance being lowered down by EAPM. We already have the expectation of Indian IT sector probably reporting lower than expected QOQ growth. But on a net basis, it's a sector wherein you can expect much less volatility compared to some other sectors.
Right. So that was the perspective on the IT sector as well as FMCG, overall, and how they are going to react. We're going to have other rate sensitive sectors also, which is going to react in a similar fashion, you could say. But let me go across to Lata Venkatesh, who's joining us live from the RBI building there. How are you reading this whole stance that the RBI has taken, not changing its stance, as well as staying to the status quo of 6.5 when it comes to the repo rate? Lata.
Okay. Well, actually, both the stock and the equity bond and equity markets were hoping for a slight reduction in the inflation forecast, because the past two numbers have come in way below RBI's own forecasts. But actually the governor has not cut the forecast much. It's been cut only by 10 basis points. So that should count as a little hawkish, or at least not as dovish as expected. As well, there was a repeated insistence by the governor that RBI will not be happy if they just got to below 6%. Remember, the set target for the MPC is get CPI to 4% with an error margin of plus or minus 2%. So the broad range is 2 to 6%, and there was much celebration when inflation went below 6%. The governor repeated at least 4 times in his speech that we will not be satisfied with that, we won't be complacent, we want inflation to come down to 4%. And remember, his forecast for the average for the current year itself is 5.1, which means he's pushing out rate cut expectations. Both these have been taken by the bond market as not dovish or slightly on the margin hawkish signals. But I'm really, splitting hairs here, marginally hawkish. Otherwise, the broad part of the policy is on expected lines. They were not expected to hike rates, continue with the pause. They said that the stance of the policy will remain withdrawal of accommodation to align to the inflation target and support growth. That is that is verbatim cut paste from April and previous policies. So really it is 99% on expected lines. The minor dovishness that was expected has not been obliged by the MPC. So you could see a mild reaction in the bond markets. Yields are about 2 basis points higher as far as the 10-year yield is concerned, and there is no big Diwali among the banking stocks either, or in the stock markets. I would say that's the broad takeaway, that it is on expected lines with a marginal hawkish tint. Just a couple of observations for the unlisted space. They're going to issue guidelines on first loss default guarantee, FLDG, as the jargonists call them. This is important in the unlisted space because a lot of fintechs give these loans, and they give a guarantee for the first loss that the borrower takes, which is a big attraction. Now, that is going to be regulated. Anything regulated is always positive, because that means it is allowed by the Reserve Bank. So that might be on the margin positive for the unlisted space, the fintechs. There are some other rules in terms of large banks can set their own call market limits, which could be positive for PSU banks. But, those are marginal, nothing moving the EPS, so not to worry about that.
Right, Lata, then that means we could rule out a rate cut this year at least, and maybe look at it next year as one section of the market believes, right?
Drawing from the swap market, an 80% chance of a rate cut in February is what the pricing is indicating, and perhaps a more 100% in the April swap market. So they are pricing in a few more cuts in June, marginal, but the point is not in 23, definitely calendar. If you go by the swap market, actually only with difficulty even in February. A small chance in February as far as the swap markets are concerned. So I don't think we should be talking about cuts just yet.
Sure, we should not be talking about cuts just yet. With that, thanks a lot, Lata, for taking out time and joining in and sharing your perspective with us. With that, let me go back to Anil Rego then. Anil, what happens to home loan EMIs then going forward, given the fact that, we have seen the RBI hiking rates by somewhere around 250 basis points over the last year or thereabouts, which has resulted in an increase of over 20% in home loans rates. Actually, going forward, how can one minimize their EMI burden, given the fact that, the previous rate hikes that have been announced will take time to, in fact, take effect. So how should one go about minimizing their EMI burdens going forward?
See, if you are already, a home loan borrower, then you would have seen some of the impacts already have happened. Right? So, and they have been passed on. So it's not that, they have not seen the changes happening. At the same time, I think, it's a whole lot of thing around banks, their liquidity and all of it, and, how they sort of tend to pass it on. So I think that we will also see a pause, and we probably where we are right now on the home loan side for a period of time, broadly in line with sort of RBI policy, because I think in this period we'll see things moving in a narrow band, in my view, right? So for a home loan borrower, what does one do? Because you would already have seen higher interest rates kick in for you on the variable home loans. So there, yes, you need to look and see how long is your tenure increasing. Okay, and if it's increasing beyond a point, can you do some repayments and stuff? You can also go back and see what is the rates prevailing for new home loans, and if you find the difference is about 0.75 to 1%, okay, from what you have taken, then you can go back and again reprice and take a new loan out there. So of course, at this point of time, I'm not suggesting looking at a fixed rate, because it's a lot higher. But if you're able to get a fixed rate which is closer to where you are, then keeping in mind that possibly we've seen the worst behind us, if it is say at 7.5 or something like that, if you're able to get at some point of time within these next 3 to 6 months, if you get, then that's also something that you can do and lock it in. But because one is expecting that interest rates actually could stay where they are or come down, that's not the preferred one. Okay, you would rather wait out for rate cuts to happen and then only go back to a fixed thing. So today, if you are on the variable side, maybe just see how you can reprice it, how you can repay, so that you are not increasing your tenure too much.
Right. Anil, the governor also did speak about RuPay cards and how they are gaining acceptance even abroad. He said that there will be now more foreign entities that will be also be putting out these prepaid forex card. We just saw that whole TCS 20% hike that had come into place. How is all of this panning out, and why was this necessary at this point?
Yes, so I think this whole TCS for foreign payments is definitely a negative. I really hope that this is something that will be relooked at, and definitely not at the percentages that we have now. I think closer to 1 to 5%, I think is an okay thing to see, because you want to bring people into the tax side, right? So you want to bring people in, and from that standpoint, it may make sense for you to for the government to relook at it. Because it's a little against a free economy, right? So we're saying India has progressed so much, and it really makes sense for us to make that change. That yes, but I think all of these are coming in as a measure to see how they can sort of comply, right? There's going to be a whole lot of work by banks and all of them and credit card companies to see how they can make this tax reduction, etc., seamless. Right. So today, if you ask me, everybody is trying to grapple with the operational aspect of actually being able to execute this. So some of these policies, and I think the RuPay and all of it may be ways to see how one can streamline and make some of these compliances easier.
Right, coming to Kunj then, Kunj, with the way things are going domestically, we are, on a strong footing. GDP for FY23 had crossed the 7% mark, positive surprise there. Inflation is cooling off. And of course, how inflation shapes up will depend on El Nino conditions going forward. But, a lot of market participants have started talking about 1 lakh on the Sensex in the next 5 years or thereabouts. I want to get in your views on that.
Sorry, I missed your last statement. One what on Sensex?
1 lakh
1
on the
lakh
Sensex,
number. Okay.
Yeah.
Okay. Yeah, you should always be positive. There's no harm. If we look at historically last 10, 20, 30, 50, 100 years, the economies have grown. There's absolutely no doubt. Now there have been two things in that. One, the rates of growth have varied. There have been periods of lesser growth rate and there have been periods of higher growth rate. And two, within that, there have been volatility. There have been periods of recession also if we take a 100-year long time frame. The same will be the case going forward as well. Yes. So you can always say that Sensex will be 1 lakh, but can I say when? At least I can't. Maybe some people can. So yes, given the way, if we look at the way Indian economy, let's say if I talk of next 25 years, probably an annual CAGR somewhere around 3%, 3.5% in next 25 years, Indian economy should be able to deliver. If it delivers that, if I look at calculate in terms of market cap to GDP, we could be 1 lakh numbers. If I calculate in terms of the 3.5% 25 years CAGR impact that will have in the corporate earnings, let's say 5% CAGR corporate earnings, Nifty or Sensex earnings grows, and if I give a multiple, we can be at 1 lakh. So yes, the whole question is the capability of the investors, market participants, traders to be able to bear the short-term volatility. But if someone has a real long-term, one need not be worried.
Right. Kunj, I also want to get in your thoughts on the FMCG basket. We've seen the index hit record highs, ITC firing on all cylinders. HUL, in fact, there are some volume concerns, but looks like, it all depends upon how, of course, rural demand shapes up going forward. But, here on, do you expect some price correction to set in when it comes to the FMCG basket? Or do you think one should actually look at this space now, and this space will take leadership going forward? What are your thoughts?
Yeah. So in terms of what we were discussing earlier, also the Nifty and Sensex large cap indices, if we look at last 2 months, they have approximately risen around 10%. Thankfully, mid cap and small caps have also shown participation and have outperformed the large cap return. Now, in this 10% kind of large cap return, there have been few sectors which have clearly outperformed. So one has been automobile, has done very well. The second has been capital good, and third has been surprisingly FMCG. Why I am saying surprisingly is that FMCG is a low beta sector, and you don't see that kind of sharp movement coming in by a low beta sector or a participation coming in by a low beta sector in a sharply rising market or in a sharply falling market. But that was the case here. In my view, what were the reasons? The reasons were that this 10% last 2 months rise was probably because of one of the reasons was because of the sharp FII inflow returning to India. Now, when FII inflow comes to any market in the first phase, after having been a period of outflow or a non-participation, they first look at the large cap blue chip names. And which is where, in addition to some of the banking, capital goods and auto mainly, FMCG sector also came in. We had and have companies with strong brands, a strong cash generation, negative working capital, very significantly wide distribution network having been built in. The only challenge to the whole sector was the growth rate, the top line and the demand, the consumption slowdown that was there. So yes, coming back to now, going forward outlook from the sector, possibly if we see a market correction, we could see the correction coming in the FMCG also. On the other hand, what I am hearing, if one does secondary market check, is that some of the companies are planning to pass on the recent price benefit in some of the raw material prices that they have got. Now, if they do that, if they reduce their prices, on the other hand, we see the normal monsoon coming in, one doesn't know. On the other hand, while interest rates are not going to come down, but probably the consumer has a certainty that it will not go up. So he'll start to rework his budget. he will probably start to reallocate his money to discretionary consumption, some of which might get higher allocation in the consumer goods also. So those could be the positives for the sector to continue to do well. And as a result, then in that case, we might not see the correction. But still, if I were to summarize, yes, with the market correction, we could see the elevated valuations for FMCG sector, which are at current level, coming down a little bit.
Right. Madan Sabnavis, the chief economist at Bank of Baroda, is also joining in. Madan, your first views. We've seen just the inflation bit that has come with some bit of downward revision by the RBI, but everything else is remaining at status quo. How are you looking at it? What is really going to change according to you from here when it comes to the banking sector? At least this is what is expected from. You can unmute yourself.
Sorry, there are two things on this particular issue. One is that while the RBI has lowered the inflation forecast to 5.1%, it's very, very marginal, so it may not really stand out. But I think what is important is the trajectory of inflation for the course of the year. So for the first quarter, we're talking of 4.6, and subsequently it's going up to 5.2, 5.4, and then 5.2%. So on the average basis, it may not make a difference. But earlier, we had taken a view that it's quite possible that from October onwards, the RBI could be seriously considering a lowering of rates. Okay, let's assume that we have a normal monsoon and these numbers really hold. Then there was a case for thinking that the RBI could be lowering the rates. But I think now, given this kind of a trajectory where we're saying that the quarterly inflation is going to peak in the third quarter, I think that can probably be ruled out for the time being. So unless these numbers change drastically, I don't really think that there could be a rate cut happening in this calendar year. And the earliest would probably be in the fourth quarter of this year, or the first quarter of the next calendar year. The second part is in terms of the overall liquidity management. I think what the RBI has mentioned about the surplus liquidity and the V3Rs, which have been invoked by the RBI. So I think that is something which is going to be a continuous process, given the fact that the 2,000 rupee note, which has been withdrawn from the system, is going to show up in the banking numbers, both in terms of the reduction in the currency in circulation, as well as an increase in deposits. Now, to the extent that the deposits keep increasing, we can be seeing this surplus liquidity being in the region of around 2.5 lakh crores. So there will be more of these auctions coming in. Now, what this really would mean for bond yields is that the long-term yields would be rather stable at the current levels. So when we're talking of a 7% going for the 10-year yield, we can talk of a range of maybe 6.95 to 7.05. However, at the shorter end, when you're looking at the shorter maturity bonds, I think that is something which could probably remain fairly volatile. Volatile in the sense that depending on the state of liquidity in the market, the days when we have excess liquidity, they could be declining. The days when it becomes more stringent, there would be a tendency for these rates to go up. So I think there would be a bit more a movement in the yields out there, whereas the 10-year yield appears to be fairly well anchored. I think these are the two major takeaways as far as banks are concerned. And then, of course, depending upon how each bank views its own assets and liabilities, I think decisions could be taken on interest rates. But in general, I think the status quo will probably prevail for the next couple of policies.
Right, Madan, you spoke about the VRR, VRR options, but, there's very, banks in fact are unwilling to participate in that. There's no demand coming in from bank on that front. How do you expect this process to continue if there is, banks remain on the sidelines and do not participate in it?
Yeah, I think what is really going to drive participation out here is one is how banks look at the overall demand for funds in terms of credit. The second is, of course, the maturity of the tenures of these VRRR. Because, for example, we look at what happened yesterday. It was, I think it was a 2 or a 3 day auction. Now, when you're talking of a short term, just before the policy, there would naturally be less response because one will always tend to be cautious. Similarly, if we're talking of 14 days, one should remember that last year we had instances where banks had got themselves locked in for 14 days VRRR, and there was a shortage in liquidity, called money rates went up, and the RBI had to intervene through a VRRR. So I think banks want to play a bit safe out here. So I think depending upon how they look at their immediate demand for funds coming from corporates or maybe from anywhere across the credit spectrum, based on those projections, they would be parking the money for these VRRR. Ideally, I think if they're of shorter durations, maybe 3 to 5 days, the response to my mind should probably be better. now that the policy is over and banks are quite clear about what the RBI position is in terms of growth, inflation, and their overall stance too.
Right, Madan, if you talk about, the interest rate differential between US and India, it has narrowed down to historic lows, in fact, just about at 1.25% right now. And if the Fed hikes rates either in June or July, this will narrow down further. How does it bode for the Indian currency going forward?
Yeah, I think that is clear because I think while the RBI has always maintained that monetary policy decisions taken in India are going to be based on domestic considerations, I think whatever happens in the West, especially what the Federal Reserve does, I think that's going to play a major role in terms of the flow of funds as far as foreign investment is concerned. And I think that's something where we are fairly vulnerable because when I look at both FDI and FPI, the way it's behaved last year and also in the last couple of months, I think that is something which could definitely be influenced or be impacted in case the Fed continues with increasing of rates. So I think next week will be an important data point when we'll get to know, because there's a fairly evenly divided view on whether the Fed will be increasing rates or is it going to be a pause forever. So I think that will be a major data point to look out for in the next week.
Absolutely, the Fed's decision will definitely have a bearing on most of the other economies around the world because that's where it takes its cues from. Dipti Deshpande, the principal economist at CRISIL, is also joining in. Dipti, give us that comparison about India as well as the US and how both of these are playing that wait and watch game at this point, but you have the macro data which is a different telling picture. So how is one supposed to view this back home here? Are we just going to keep waiting and seeing what the Fed does and then take stances here?
Yeah, thanks for having me here. I think one word that we've been speaking or using for a very long time continues, and that is uncertainty. Be it the US economy or India, I think we've been taking certain steps. The RBI's announcement today.
Right, I guess we are not getting your audio rightly there, Dipti. We'll come back to you, but let me go back to Madan then and ask him this. He did give that comparison of how would the Fed and even the RBI, literally all central banks, we have a couple of them who are hiking rates. Looking at the global scenario, when we're talking about a slowdown, we're seeing a recession in Germany already declaring that. How much is that going to have an impact? Definitely the Fed also really closely keeping an eye out on that, but how much of those macro points is one supposed to be reading into?
I think these are important because I think the way in which we view inflation is very, very important. So I think any decision which has been taken or will be taken by the Federal Reserve or the ECB, the ECB and the Bank of England are going to probably continue increasing the rates. But I think it depends upon how they look at the inflation position and how they see it panning out. So even here, if you'll see the RBI's governor's statement, he's also mentioned something about the risk factors, not just in terms of El Nino, but also in terms of crude oil price and other global commodity prices. So I think there is a bit of uncertainty about what could really happen out there, because if we are looking at certain countries, like say, for example, if China suddenly shows a greater pace of revival, there would be a tendency for the commodity prices to go up, and then that would keep percolating to all other countries. So I think it's a kind of a concerted view which has to be taken by central banks. And so when we are talking of certain central banks suddenly deciding to increase rates after taking a pause, I think it'll be more upon the specific circumstances of the special conditions which are there in their prevalent economies and how vulnerable they are to these movements in the global commodity prices. We've already seen that crude oil, which we've all taken for granted, will remain fairly benign during this financial year, is something which is also showing some signs of an uptick after the Saudi action. So these are the uncertainties which are there, and until we get greater clarity, I think there should not be any hurry in terms of increasing the rates, because I think the markets all over have buffered in the fact that inflation is high. Central banks are going to probably retain their positions on monetary policies, and they are not going to be reducing the rates anytime soon. So it's only when you create these expectations that central banks are going to lower the rates, I think that's when you create this kind of disruptions in the market, and the market then starts reading a lot into every word that is said by central banks.
Right, I think with that we have Deepthi back on with us. Deepthi, if you can hear us, you were giving us your first take on the RBI policy fine print, and of course, I also want to ask you whether the governor is being a little too cautious when it comes to inflation, given the fact that the inflation figures have been scaled down just by 10 basis points for FY24, and on the growth front, are we being a little more conservative because given the kind of surprise we saw with respect to FY23 GDP, do you think there was a case for an upward revision in FY24 GDP forecast from the RBI?
Yeah, so thanks for having me. I hope my voice is clear now. I think on our first take on the policy, it was absolutely as per our expectations. We did not expect any change in the stance nor any change in the rate movement. And I think there are two key messages from what the RBI has clearly said. Number one is the fact that they have a comfort on the growth momentum as well as easing on inflation. And hence, there hasn't been any more rate hike action. Second is clearly that although inflation has been coming down, it's within their comfort band. There is still some comfort because it's away from their 4% slated target. This time, they've specifically mentioned that they would like to see inflation at 4%. Also, throughout the year, they are not expecting inflation to come down to 4%. I think that brings in a little bit of cautiousness, and hence they have, kept the withdrawal of accommodation stance as is. So broadly, if I go to say, I think the central bank is playing it pretty cautious, which is the right thing to do at the moment because there's global uncertainty. Like we were discussing, central banks are still pausing and then moving, etc. There is also domestic uncertainty. We are going by the assumption of a normal monsoon, but we really need to watch through it. So I think the cautiousness in what the RBI has done is required at the moment. Another important thing that the governor said was towards the end of his speech in the very last para, where he did mention that they are also inclined to keeping inflation expectations down even in the long term, so that inflation stays at around 4%. So I think cautiousness is something that will prevail for a while. Our own expectation is that inflation should be at around 5%. So RBI's call of at about 5.1 is very close to that. On growth, broadly, we do our expectation, in fact, is still pretty conservative. It's at about 6%. RBI is upped it a bit to 6.4. Broadly, I think the numbers so far have been good. We've seen some sort of a cheer, but the impact of past rate hikes, number one, is yet to be seen. And our expectation is that some consumer-faced interest-sensitive segments like consumer durables, auto, etc., should face some heat in the coming months. So I think it's important to look at that. Secondly, is that normal monsoons are being predicted, but as he also rightly mentioned, spatial time-wise distribution, etc., is important to be seen. And thirdly, geopolitics, is still not in a good zone wherein prices can come down materially. So input prices on a year-on-year basis are lower, but they still remain fairly high for manufacturers. So all these three factors, I feel, will have some bearing on growth, and therefore it's a cautious step forward. And I think that's what's required at the moment. In terms of a rate expectation, we are expecting a repo rate cut to come by somewhere in the first quarter of the next calendar year.
Right. Deepthi, correct. So you've given us an overall perspective. Let's look at it from the Aam Aadmi. What really changes for you and me? Well, EMIs, we're not going to see much of that change, but is this a good time then for one to see? We are anyways at a high interest rate cycle, so and we're not going to expect any cut in this year, at least for now. So what can one expect on those lines? Is it a good time now to take a loan, or should one wait for those cuts to come in and then go ahead?
I think for the Aam Aadmi, the number one takeaway is that inflation is on a downward trajectory. So compared to last year, things are going to be a lot more affordable. I think fingers crossed on monsoon, of course. And on the interest rate scenario, I personally think from a consumer perspective, right now, I'm aware that interest rates are high. Most of the transmission, especially to auto and housing growth, has been done, but soon there's a turn in the inflation cycle also coming by. So an Aam Aadmi taking a loan will look that much into the future. So I believe this year there could be some softening of demand coming by in the coming quarters per se. But the outlook for FY25 is brightening.
Right, that's the view coming in. But let's also get on board then Ajay Bagga of Elements Platforms to talk about, the markets and going forward, what we can expect from the RBI. Good morning, Ajay. Good to have you on this coverage. First of all, your take on what the governor has done. We have largely stuck to the script, but do you think he could have scaled down inflation forecast for FY24 slightly more than just about 10 basis points?
He's just been cautious because, Nandita, you have a monsoon which might be in trouble. We don't have the exact focus of that. And frankly, you can't really very accurately predict the monsoon. So I think they've been a little on the conservative side. But clearly, inflation is going down. And if you just calculate it also, 4.7 in April, going to maybe 4.3 to 4.4 for May and June also in that. So they will be below their number for the first quarter itself. But they have kept it high. That is very clear. But there is a base effect which comes in negatively come October. So, they are being cautious on that end. And then the monsoon, though, the food impact should be limited. Even the economic impact normally should be limited. The intensity of the monsoon's impact on the economy has gone down, but still they are being cautious.
Right, caution is the word when it comes to this RBI policy statement. But Ajay, what do you make of this current leg of rally that has pushed us closer to record levels, 18,700 or thereabouts right now? Markets had in fact factored in a pause from RBI any which ways. But going forward, any other risk aside of monsoons that is arising right now? Of course, globally we have the Fed meet next week, and looks like even Fed will follow the same script of holding rates in June and maybe coming out with a hike in July, like how Australian and Canadian central banks have done. What are your own thoughts? Do you think another hike by Fed could could derail the kind of up move we've seen in the markets, or even that is factored in for now?
It's not factored in because, yesterday when Bank of Canada raised rates, you saw the Nasdaq going down by more than 1%. So mostly the markets are at a pause. What the central bankers are saying, even if we pause, don't think it's a pivot. It could be a skip and a hike. So that's what the markets are not taking into account. And you see the growth stocks have really gone up quite strongly. And it's been a very concentrated rally in the US. The top 7 stocks are now nearly 25% of the market cap. They are more valuable than the last 300 stocks in the S&P 500. And if you take out the performance of the top 10 stocks, then against an 11% rise this year, the S&P 500 has risen only 1%. So that's the kind of outperformance. It's a very concentrated move up that has happened. A lot of commentators are saying it's a lot of the quant money which has come in. The human fund managers are very cautious, like all of us. I am expecting one correction in the US. The market bottom has not got formed yet. So calling Nasdaq as another bull market or S&P at the inception of another bull market, that's taking a very technical view that it's 20% up from the October bottoms. But if you take the view that it should go above the previous highs, and then you can say it's another bull market, that we have not reached. And I think there's a correction coming in the US economy and the US markets. That's what's holding us back. Otherwise, with the flows turning superbly positive, with the economy on a strong footing, our market would have been nearer to 20,000. It's more the global impact which is moderating the impulses in our markets.
Right. So Ajay, you're saying definitely a correction expected in the US markets and economy as well, but also the fact that that will have a bearing here back in India. Madan, if I have to come back to you, give us your closing statements. How would you really rate this, because it's a status quo as we know it, but what should one be looking out for more keenly? Yes, the Fed policy is going to have a big bearing on all the moves from here, but what would be your last word?
I think the last word would be that let's not really expect any kind of a rate cut in the current calendar year. And I think going purely on the basis of the numbers which the RBI has put out, it looks like that the earliest we could expect is in the first quarter of the next calendar year. That's January to March. That's what the market will have to realize, and we will have largely a lot of, let's say, stability in terms of bond yields, especially at the longer end. But depending upon how the liquidity picture plays out, there could be short-term volatility, volatility at the shorter end of the spectrum.
Right, so don't expect a rate cut in this calendar year. Ajay, would you concur with that?
Reportage based on his reports. So he's called it right. My personal thinking was October would be the first cut, and they would have to do a 75 basis points rate cut over the next 2 quarters starting October. What has put a spanner in the works is Canada and Australia pausing, skipping, and then hiking again. So I think there'll be some pressure on the Fed. Right now, the Fed futures are showing and even about a 50% chance of a July hike. My personal thinking is they've overhiked already. Probably they should stop now, but who knows? So if there is a hike in July, our move will probably get postponed to January. So if the Fed doesn't hike in July, then October, November rate cut should come in India. That will be predicated on 2 things: a US slowdown. Yesterday, their trade gap came in at 23% higher year on year. So clearly, there is something cooking. The Chinese exports fell 8% plus year on year yesterday. We got those numbers. So there is a slowdown. The supply chain numbers, if you look at the Baltic freight indexes, all those are showing a slowing trade, a slowing export imports that are happening globally. They are precursors to a slowdown in the global economy. So I feel that December could see a Fed first cut, even though the dot plot on 14th will probably still show that no rate cuts in 23. They're very adamant on that. But a slowdown could push every central banker's hands. So that is the thesis for India also to cut around October, November in anticipation of a Fed cut after seeing a US economy slowing down in the 3rd quarter of this calendar year.
Right. So if I have to sum it up, I can say that the RBI is on a wait and watch mode. You could say being cautious is the word that is coming out from most of our panelists, and I like to thank them there for giving us that time. Dipti Deshpande, Madan Sabnavis, as well as Ajay Bagga, thank you so much for giving us your perspective. Let me then speak to Nandita now, because this is what we were anyways expecting pretty much.
But we were also expecting a dovish tilt to his statement. That didn't happen.
Which has not
However, markets
now
have really factored in, a pause and a stance which would be retained at withdrawal of accommodation. So no negative surprises. But we are trading around that 18,750 mark any which ways, and we've been there for quite some time. So it was really priced in by the markets. So for now, I think no negative surprises and wait and watch mode when it comes to future rate path.
Yeah,
so that's the word.
The markets really kind of in that mode, wants to keep the momentum up, but this was something, the one data point that they were looking forward to, but not much.
Fed next.
Yeah, so next I guess all eyes will have to then now move next week to the Fed's decision, because that's going to have an bearing on how global markets will really perform. But with that, it's a wrap on this special coverage, taking a deeper dive into what RBI's monetary policy was for the month of June.
Thanks a lot for watching.